Hi friends, hope everybody is doing good and everybody will be happy also because market is at lifetime high. But at this point of time, I would like to caution everybody on this. See, I am a person who have seen 2008 January. I don't have to explain in detail what happened in 2008 January. I went bankrupt in 2008. There also almost a similar thing. What is happening now had happened. Like if you see the number of new demat accounts getting opened jumped drastically between 2007 November and 2008 January. That there was a reason for that because of R Power IPO, one of the biggest IPO Indian market has ever seen. To get into that IPO, people started the demat account, and once the demat account is opened, then people will think, okay, I've already opened the demat account. Why can't I buy some shares? They start buying it. Then once with that start buying without even looking at what is exactly happening and what exactly they have to look into before buying a stock, they'll just keep on buying it. Buy, sell. It was just keep on going on. Then suddenly, then these so-called investors who came into the market, who opened the demat account, started thinking of doing investment, they starts doing trading. Then the margin part comes in. Then the leveraged funds. During those time, banks were supporting people for with leverages on getting into buying onto shares. Even we can buy uh, shares in cash with having a guarantee of an existing holding. So that all has been stopped right now, but in those days it was possible. So basically people got into it. A lot of people started buying it, because of which the prices of most of the shares shooted up and it became a balloon. And when a balloon is created, when the size of the balloon goes bigger and bigger, a very small pin is enough to just burst it. And that is what happened in 2008. A small negative news flow came in, crashed. Everything went to water. So there ends it. Then a lot of people started saying, "Oh, this is not for us. Market is done by operators. Government is not looking into it. SEBI is not working on it." See, you have to understand one thing. All these authorities, SEBI, government, everybody, they are doing their job. The only people who are not doing their job is the people who are coming new into the market. They are just entering the market, buying and selling shares as if you are buying a vegetable and selling it from one price you buy it and sell it with a 1 or 2 rupees profit to another person. See, that is not the share market is. Share market, basically, it has got a value. Every company has got a valuation. Without knowing what valuation is, what the price to earning is, if you start buying shares of a company, tomorrow is very small thing is enough. Very small news is enough. If market in March 2020, if market can come down from 12,000 to 7,000 in hardly 1 week, definitely you can understand. The time which it requires to go up, fraction. Start like in 19th December, we had a fall of around 700 points. But to make that 700 points before that, till 19th December 2020, it took 11 days for the market to make up that 700 points. But that 700 points were wiped out in just 5 hours. So what it took 11 days to make it was wiped out in just 5 hours. And that the market is. So the crashes will be uh, that strong than the weight is going up. It will be almost 10 times. You have to always understand, if a stock goes 10 rupees in a day, it takes hardly 1 hour for that 10 rupees to fall down. So be very careful and be cautious. Try to learn first of all. Now what has happened is that, if you see, I don't know if you people are looking into the mutual fund activities since last 1.5 2 months. Every day mutual funds are selling it. Why they are selling it? They are professionals. They will not just keep on selling the thing when the market is keep on going up. They are selling it because there are a lot of mutual fund redemptions. The low people who has started demat accounts, there is millions and millions of new demat accounts has been opened in the last 6 7 months from April to December. The government data says that. And what they are doing is that they are redeeming their mutual funds, and because of that, mutual funds are selling the stock to make sure that the redemption happens in time. So, and redeem this mutual fund, take that money and put They are doing it directly onto with their demat account in the stock market without knowing what exactly it is. I get messages almost every day, people asking me, give me some penny stock, which is less than 10 rupees so that I can buy it. I ask them, what is that? Whether it is penny stock or whether it is Reliance, which is 2000, what difference it makes? The calculation has to be on percentage wise. If a penny stock of 10 rupees goes to buy up by 10 paisa, which is 10%, 1 percentage, or 10 percentage, the say with that much time is required only for the Reliance to go up from 2000 to 2200. So this is the difference. You have to understand one thing is that it's not the value amount what you're talking about. It is the importance of that company and whether that value is applicable to that company, whether that company's valuation deserve that value. So this is what important, this which people are not looking at. TCS is trading at 30, more than 30 price to earnings of 2023. It is something which is not practically possible. So any small, very small negative news impact, it will just crash like anything. That is why a balloon, the more it becomes bigger, it's very easy for it to burst, and that will happen. So for that not to happen, we have to make sure that we enter in such a stock which has got some futuristic value addition. When the share price goes up, like for 3 months it goes up, and when after that 3 months, when the result comes in, if that whatever it has gone up, if the profitability of that 3 months of that company doesn't match with that share price increases, definitely it will fall. So that 3 months gap is there for operators and professionals to manage their risk. They will know exactly where to enter and where to exit it. But the retailers, what happens is that in those 3 months when it's keep on going up, what they will think, and they will just keep on buying it. By the time the result comes in, the result is not competitive enough to match with the valuation of the share which has gone up in the last 3 months. The professions will, or operators will just dump that stock, wherein the retailers get stuck, and retailers has got a psychological issue where they will not sell any stock in loss. They will just, they don't know what stop loss is. They'll just keep on averaging it. See, just imagine Reliance Communication. I have got only one stock in my demat account. I'm a full-time trader, but I don't have anything in my demat account. I don't buy anything and keep it. So only one share I'm having in my demat account is just one number of Reliance Communication, which I bought in 2007 at 630 rupees. Just check the value today. It's 30 paise, I believe. So 630 rupees, I bought it in 2007. And just keeping in my demat account for me to see almost every day and tell myself that yes, this is stock market, which was at 630 in 2007. After 13 years, doesn't have any value. So we have to understand this thing. These things can happen. The other way also it will happen. When I entered into the stock market in 1998, the price of a MRF share is less than 3,000 or 4,000. But today it's at 1 lakh. So both sides can happen. But the success in stock market is how you are controlling your risk. The loss, minimization of the loss is the most important than maximization of the profit. The less you lose in the market, the more you are benefited from the market. Now, let us come to the options. Why I am doing this video is that in last 2-3 days, I got a lot of queries on my WhatsApp and Telegram. People are putting messages saying that they are holding such and such options and they don't know what to do. And almost everybody is having call options because market is going up. So people are just buying. People are saying, okay, every day the option is going up. So, but one thing you have to understand, the option trades not just based on the share price of that company. Option has got a lot of things to, in options, there are a lot of things involved, which decides the price of that option. So in the most important of that is the option Greeks. So let's understand first of all, before getting into the venturing into options trading or options this thing. And before that, let me tell you one thing. Options is basically not a trading script. It's a hedging instrument. It's purely an hedging instrument. Options are used only to hedge your positions. It's not used as a trading script by professionals or operators. They are using it as a hedge. Even I use it as a hedging purpose only. I don't buy on or trade in options. I trade in futures, and to hedge my overnight position, to reduce my risk, I buy options. Or the maximum what I do in trading is option is that I sell options. I write options. So that is there with, but the limited calculated, very much calculated risk, because the risk in option writing is very high compared to buying an option. So I have my calculation and I stick to my calculation. I will not risk more than what I have already calculated. Now let us come to this Greeks. Let me make you all understand what exactly it is. Before venturing into options trading, you have to first understand these part, the Greeks of the options. And the most important for that, with the people who are small retailers doing one lot or two lot, the most important in that is the delta. The delta defines the price of the option. Let's understand for now how a delta works out. This is the option chain of Nifty as of Friday closing. And the ATM call is at 14,350 and ATM put is at 14,400. And the delta is like almost on the Thursday morning. This ATM, this 14,400 call option, the delta was around 63 or 64. That means when 1 point goes up in index, the option price will go by 0.63. This is how. It is like, it is 0.48 now. Like 1 point goes up in index, it is 0.48 will goes up in the options. It will not that 1 point itself will go up. If the index is now is 14,371.9, if it becomes 14,372.9, option price will not go from 125.1 to 126.1. It will go up only by 48 paise. So this is the importance of delta. You have to understand what delta is. This will keep on changing, and the change in this is determined by the gamma, which is not applicable for small traders. Gamma is important only if you are doing a delta hedging with multiple lots, like hundreds of lots. Then only the gamma part comes in. Otherwise, normally it will look like 0.001000. So it will just keep on. It will not make much difference. Or that is applicable only for high-end traders. Because I do in index trading futures, or whether it is future or option, whatever it is, I do it in lot size of 21 lots at a time. It is 21 or above. That is my calculation. Each order will be 21 lots. So here, this is the thing. Delta, it's only 48. On Thursday morning, 14,400 delta was 64. That means at that time, 1 point increase in the market will increase the option price by 64 paise. But now that has been reduced because the market has fallen. So that is the most important thing you have to understand. When the market goes on the reverse side or on the opposite side of what you are planning for, if you have purchased a call option on Thursday morning of 14,400, the option price will keep on going up by 62 or 63 or 64 paise for every point goes up. But now, since the market has gone the opposite side of your calculation, then everything comes down. It's not only now on Monday, it will be like only 48 paise increase will be there for every 1 point which goes up. So it's not only single for the complete month, it goes up at the same value. This delta keeps on changing based on the market levels. And that is the important thing, what you have to understand. And here what I have mentioned, change in option price with 1 rupee change in stock price is nothing, and if nothing else changes. Example, delta of 1,500 per lot. Like means if you see State Bank of India, if the delta is 0.5, means when 1 rupee goes up in State Bank of India's share price, 1,500 you will get in a option if the delta of that particular option which you have taken is at 0.5. if you bought a lot of CE options, you gain 1,500 rupees when stock goes up 1 rupees, and lose 1,500 rupees when the stock goes down by 1 rupees. So the thing is, what you have to understand is that this going up and going down will keep on changing. The moment the price, the stock price goes based on how you have calculated. Like you have taken an option of SBI 300 CE call option when the price, when the share was trading at 298. At that time, the delta will be 0.5. But after 2 days or the next day, if you see, if the share shoots up to 305, this delta will increase. So you are having an advantage. So if the price moves as per you calculates, your advantages keeps on going up on the option side. But the double loss will happen if it goes the opposite side. So now what happens is that, like when you enter the State Bank of India option, you have entered thinking that it will go up. You entered the 300 CE, bought 300 CE when the stock was trading as 298. Now imagine the stock is coming down. So when you entered the option, the delta would have been 0.5. But now after 2 days, if it comes to if the price comes to 290, then your delta also falls down. Then the delta will become 0.3 or 0.4. That means after the next day onwards, when the price goes up 1 rupees, you will not get 1,500 rupees. You will get only 750 or 800 rupees. The price movement of that option. So you have to understand all these aspects into it, that delta is the most important thing when you are trading an option. Now the second part comes in is the theta. That is basically the time decay. You have to understand the options you are buying with a premium. This 350, let's take 1,350 call option. As of now, it is trading at 152 rupees 40 paise. But the actual value of that option of 14,350 call option is only 21 rupees 90 paise. That is the actual value. You are paying 131 rupees for nothing. That is called the premium, and that premium will get eroded by almost every hour. Every hour, it will just keep on eroding, and that is calculated based on theta. This is called theta. Theta tells you what will be the change of the option price if nothing happens onto the share price the next day morning. Change in option price when change in option price after 1 day if nothing else changes. So like in this case, if you see 1,350, let's take it 1,350. The theta is 11 rupees. And the day which I am talking to you right now is a Saturday. So the theta was calculated based on Friday or the close of the market. So the theta is for 1 day. That means on Saturday, it will have a reduction of 11 rupees if the stock market doesn't change. The index value is similar as 14,371.9. So the problem what happened on the weekend, you have to double the theta. That means for each share, you have a loss of 22 rupees if Monday the stock market opens at exactly the same price of same level of 14,371.9. Because Saturdays and Sundays has to be calculated. That means 22 rupees per share means per lot, it is 855. So if the market doesn't do anything, also you will lose 855 rupees per lot on a, 849 rupees per lot on a 14,350 call option. That is for sure. That is not only call, for put also. It will be the same. So that is going to happen. So without knowing this, people buy an option on a Friday evening, and Monday morning they are saying, oh, market has not changed, but my call option has fallen. That there is a reason for that. But you have already paid for that 2 days. You have already paid the person who sold it to you. Call writing. I do option trading, basically writing, call writing. I only sell calls. I don't buy calls. So I write the calls. So if I am writing and you are buying that call, means you're paying me 131 rupees for nothing. because that option which you are buying 14,350 has a value of only 31 rupees actual price. Sorry, 21 rupees actual price, and you are paying me 152. That means 131 rupees you are paying me for nothing. And that 131 rupees is the value of each day. And each day you are going to lose 11 rupees per share. That means 849 rupees per lot for each single day as of now. This also will keep on changing based on the market movement. This will happen if the market opens on Monday without any change, exactly at 14,341.9. This price will be 22 rupees lesser. 152 will become 130. It will open 130 only. So that is the importance. That is the importance of theta, the importance of calculating a theta. You have to know exactly what theta is. Now let's come into the next part, the Vega. That is also an important aspect of for retailers to know that. That is basically people buy options just before the result day, like Reliance. Friday evening after the market, there was a result. A lot of people would have bought in options. People who think the result will be bad, they would have bought in put option. People who think they are the result will be good, they are bought in call options. But only market can tell on Monday whether the market has taken the result as good or bad. We don't know as of now. Now here the problem what it is, why even I didn't take anything. I have not taken any options in Reliance. I'll tell you the problem is, there's something called implied volatility, ATM implied volatility. This is very important as far as retailers is concerned, especially during and just before an event. In this case, Reliance case, the event was a result. And implied volatility, like it was increased by 5.9 points, and it is at 41.5 right now on Friday closing. That 41, from that 41.5, 5.9 points was increased only on Friday. That means 13 to 14 percentage increase was there in the implied volatility of Reliance options. There, the thing is that this Vega, this is the Vega part. The Vega as of now for the ATM is 2050 because 2049.6 is the Reliance spot value. So 2050 is the ATM. At the time, the option which is at the value. What the thing is that the Vega is calculated basically based on the ATM option price. So everybody knows what exactly this ATM, ITM, or OTM is. See, ATM basically is the at the money, out of the money, and in the money. So strike price is basically this 2050, means somewhere between 2045 to 2055, or about 2040, less than 2059. When the stock price is at 2050, means it is when the stock price is between 2041 and 2059, 2050 will be the ATM. So there the Vega is 1.05. Here the thing is that the moment that event is already done on Friday, so when the event is cleared, the implied volatility will fall. The implied volatility which increased because of this event, because nobody knows exactly what is going to happen on Friday evening with the result. So the implied volatility increased by 13%. And once that part is cleared, when that event is closed, the implied volatility will just fall down. It is quite logic. We have to what we have to understand. It will now what will happen is that for every change of 1% on implied volatility of the ATM, you will lose 1 rupee per share. That means 250 rupees per lot. So just imagine almost 14% was increased on Friday in implied volatility of Reliance options because of this event. And now when the event is finished, implied volatility has to come down. So if it comes down by 10%, means you are going to lose 10 rupees per share on the ATM option. That means 2,500 rupees per lot will be a loss. Without any doubt it is. So when we are calculating taking a risk on buying a option just before the this one event, that means in this case it's a result event. This 44.85 is the ATM option price, call option price. So just imagine, I've calculated, okay, the Reliance result is going to be very big or very good result, the better than ever it has ever seen. So it is going to, the price is going to go up. So I'm buying a ATM option, I mean 2050 call option. The call option price is 44.85. But I will not calculate the price of, even though I am paying only 44.85, what I'll be calculating is that my price is much more than that, because what I have to calculate is this one, implied volatility. I have to expect at least 10% volatility to come down. That means the Vega is 1.05 and 10 rupees. Definitely, if the price doesn't even change anything, the price opens exactly at 2015. Sorry, 2050 also. The price of this call option, 2050 call option, will come down by 10 points. That is only for the interest implied volatility, because implied volatility, without any doubt, it will fall down once the event is cleared. One more thing which will fall down is this theta, because there are the theta is as of date it is 3.63. That is for one day. Now we have got 2 days, Saturday and Sunday, so it is almost double. That means 7.25. It's the theta. So 7.25, that will come down. 10 points will come down because of the Vega and the implied volatility. So 17.25 will come down as it is, even if the price doesn't change. If the market opens, when the market opens, if the Reliance start trading at 2050 also, my price of this 44.85 will come down by 17.25 without any doubt. So that is going to happen. 7.25, it will come down because of the theta, that is confirmed. Then basically this balance, how much it will drop, it will depend on this implied volatility. For every, in this particular case, for every percentage of fall in implied volatility, 1 rupee per share, that means 250 rupees per lot will come down in Reliance. So that is the importance of Vega. So these are the three Greeks which a retailer should know before venturing into a option. That is basically delta, theta, and Vega. Then next comes is the gamma one, which as a retail investor, I don't think you people have to bother anything about that. But that is because that is applicable only if you are doing a delta hedging. There is something called delta hedging. So that I can explain it to you once if you are coming into my webinar. Exactly, delta hedging. That is a complicated thing where you held based on the delta of an option. So there, and you are doing in hundreds of lots. So then the gamma effect will get into it, because that is basically this gamma. What it says is that for every rupee increases, this delta will change by this much value. So if from to 2050, if it has become 2051, this delta will increase by like 0.004. That is nothing comparatively. So this 5.52, if it is 520, it will become 524. That is all. So that doesn't make any difference for a retail trader as it is, but it is applicable only if you are doing huge lots and you are doing a delta hedging system. So this is the most important aspects of options. Without getting in depth of these details, if you start doing trading in options, definitely you are going to get into trouble, especially when the market is trading at lifetime high, and even the volatility index is also very high, and the volatility index is going to have a huge impact in the next 1 week because of two reasons. One is the budget on 2nd of February and the expiry week. These two factors come into with the volatility index. So the price action of options will be drastic. So better keep away from options trading during the last week of the expiry. And it is difficult also because of this compulsory delivery. the requirement, margin requirement, even for buying an option is too huge. But even then, people will take the options of next month and trade into that. But that is more dangerous because without knowing what delta, theta, and all the, because there the delta will be very small, theta will be very high. So these are things as to understand. So at that moment, I believe you have understood what exactly this Greek is. If you have got any doubt, my number is there. Just put me a message. I will explain to you what, I'll clarify it to you what your doubt is. Now let's coming into the value of time on options. See, the time has got a big importance as far as an option is concerned. As I told you, for a Nifty trade, you are paying 132 rupees for an ATM now. Like if you are taking 114,350 call option, which is the ATM call option, at the money call option, the amount which you are giving as a premium for nothing. Just if I am selling you, and if you are buying it, that means you are giving 131 rupees free to me for nothing. So that 131 will come down by time, and that is where I explained it to you where the theta effect is. Per day, as of now, it is 11 rupees. That by the time it goes down, that will reduce by the time. But the problem is there, this thing also will come down. Like delta will also will fall. So it will get compensated anyhow if the trade goes opposite of what you are expecting, then your loss in options will be much higher compared to the future or cash trading. So better, if you are a new person, stick on to your cash trading part, buy small quantity, sell it, get whatever you want, take it out, instead of playing it with option, which is meant only for hedging. And trading can be done, but it can be done only by professionals who exactly know what it is. So it took almost 1.5 years for me to understand the basics of options, how it works. So I'm into this market since, like as you said, as I told you, it's almost 22 years, and since last 11 years or 11.5 years, I'm a full-time trader. So I have learned what I have learned. I'm just trying to convey it to you people. Now the implied volatility that I exactly told you. When you are trading in option, always keep this ATM IV, implied volatility part on your screen. Keep an eye, stick on to it. A moment, as I told you, the like if you take it SBI, let's take it SBI, and this is the ATM 285. The implied the Vega is comparatively lesser. It's only 0.15 because the Vega is lesser because there is no event onto as of now for SBI. Now, if on the previous day of the SBI result, you just see the Vega. The Vega will be at least 0.6 or 0.7. That is because of the result factor. Basically, as I showed you earlier, the Vega of Reliance is at 1 as of now, and that definitely, once that is the result is finished, and the implied volatility IV will come down. Once the IV come down, the option price also will come down. Then implied volatility will be like 0.3 or 0.4 for Reliance also, instead of 1. So that is an important aspect into that. The implied volatility is a very important thing, same as price for the options trading part. Now, as I told you, options basically is not a trading script. Please don't try to trade on options. You will get into trouble. It's basically an hedging instrument. So people or professionals, basically the professionals or the people who are in the market, full-time in the market. I'm a person who sits in front of my 6 screens from 9 o'clock to 3:30 without taking my eyes off. I got 6 screens in front of me and I work onto it. So for me, I'm not a high-end professional, but a small way, I'm also a professional. I'm a full-time trader. So I'm using it as a hedging instrument. I use options only for hedging instrument, and other than intraday writing options. That is basically sudden movements when if I'm expecting, like the IV is very high. Now the Reliance IV is very high. Let's imagine the Reliance result was during a market hours. So I'll just keep that chart in my this thing. And when I know the result is going to bad, is going to be bad or going to be good. If I come to know, like if I calculate and say, okay, the result is good, I'll write a put option. But I'll write a put option based on the Vega and the implied volatility, because once the result is down, come out, that implied volatility will fall. Based on that, the price will fall. The option price will fall. For as far as right now, for Reliance option seller, he has got already an advantage of 1 rupee for 1% of implied volatility. So that is the importance of hedging, using options for an hedging purposes. But when you hedge also, basically you have to make sure these Greeks you calculate and decide which is the strike price which you have to take it. One small example I'll tell you. On Thursday morning, I shorted Nifty at I shorted Nifty February at 14,783, almost here. But even I was planning to short it at this resistance level of 14,793. But I little bit, it went up to 14,794, but I entered before that. But much before that, at almost at this point, I directly took a call option. I bought a January call option of 14,600 at 196 when the market was trading here at around 10:20 at 196. So by the time this option, February option went up to 14,783, my call option which I had already bought, it had increased from 196 to 212. So I am already in a profit of almost 16 rupees. So then I shorted here. So whatever then happens here, or small hike of 10 points after I shorted here, it doesn't affect my P&L because I'm already in profit in the call option. Then suddenly you know what had happened. So once this fall started, then I am in profit. So this by the time the lowest end of the market, my P&L showed me, because I trade in 21 lots at a time. So my P&L showed me a profit of at least 8,900 rupees per lot. But just before close, it went up, but I ended up like that day I closed. I didn't close that. I carried forward that positions, and at the end of the day, the profit was just 6,200 rupees. But next day morning, I closed immediately almost at this point. Why I closed it? That was a mistake from my. I closed it almost at 7,400 per lot profit after hedging everything, calculating everything. The net part I am talking about. But I closed it because Thursday evening, the FII data, which when I verified, they were just buying index futures. Index futures, they were buying on Thursday. So I thought when they are buying, it means today this market has to go up. That didn't happen. So I closed it here, but whatever it is, I closed with a profit only, a reasonable profit. But if I had kept it till Friday end, definitely that 7,400 would have definitely made me around 17,000 rupees per lot. So that is what hedging comes in. That is how I hedge it. I shorted February future and bought January call option. That is because of this time, like it's only 1 week. And buying a February call option means that delta will be very less compared to this January option. So, and theta will be very high. So I don't want to take that risk. Now the thing is that let's understand what is the risk of buying options just before an event, especially after on the result, just before the result day. I have explained to a certain extent the Reliance part. The implied volatility, it is higher before the event. So once the event is cleared, the implied volatility will come down without even change the price of the stock changing. You will be in loss. So there, please don't get into options just before this thing, unless and until you are sure that at least 200, 300 points, the Reliance will go up, because you are already paying a huge sum for the volatility part. That means almost you are paying 22 rupees. sorry, 250 rupees per lot for volatility alone. You are paying it. It went up by 14% on Friday. The implied volatility increased by 14%. So that 14% into 1 rupee per percentage, as per Vega, it is 1 rupee. 14%, even 14 rupees has been increased per share. You can calculate per lot how much it is. And once that result is clear, that event is closed, definitely that implied volatility will come down. So the option price will come down. Whatever happens to the share value, it doesn't matter. So that is the importance of the problem of buying an option just before the event. Now, the pros and cons of buying an option. See, buying an option means your loss is limited. Like if you see Nifty, the present ATM call option is 14,350 call option. That is the ATM. Your maximum loss is 11,430. That is your loss. You will not have loss more than that. You cannot have anything more than that. But the only problem is that is the advantage of an option buying. And now let's disadvantage if you are looking into that is basically this theta effect, the decay, time decay, and Vega, the implied volatility. It's 18.6. If you check the ATM volatility IV of Nifty before March, like let's say last January, 2020 January, it would have been around 9. So now the implied volatility is too high for the ATM prices. That is because of the market movements are too much. That is the reason. And the prices also, the market is at the lifetime high. So IV will also be very high. So that is a disadvantages as far as buying an option is concerned. Now, advantages and disadvantages of selling an options. The biggest disadvantage of selling an option is loss is unlimited. You cannot control your loss unless and until you can control your emotion. You can keep a strict stop losses. That's what I do. I don't buy options for trading part. I buy options only for hedging, but for trading part, I only I'm sorry sell options. So there the loss is unlimited, but I can control my emotions. I'll keep my stop loss in the system. So whatever it happens, I'll get out at my stop loss, whatever the value it is. And that is the disadvantages of selling an option. And the advantage is that if the price doesn't move much, the index doesn't move, it's just keep on consolidating, then you will get all these per day. Per day, you will get 850 rupees. And the volatility, if the market movement is very limited, the volatility will come down, IV will come down. So for every 1% drop in IV, you are going to get 550 rupees. So that is the advantage of selling an option. And selling an option just before the weekend on a Friday, the advantage is that this one you will get double. That is one thing. That is, people are the problem is what I'm saying. This theta is very, very high nowadays. That is what surprising me. That is because people are buying on Friday evening options without knowing the effect of theta. So that is because of the newcomers who doesn't know the basics of options. That is the problem. Now, advantage of using options for hedging. That is what I do it. I do hedging. Like imagine on Thursday, I have sold February future of Nifty at 14,783 rupees. The thing is that for a naked one option, shorting of that option, I need a margin of 1,63,000 rupees for carrying it for the next day. Or for intraday purpose, if I do it, I require almost 65,000 rupees of margin. Instead of that, what I did is that I bought a January option of 14,900 at 196 rupees, which is almost around 13,500 to 14,000 rupees. So my margin requirement for carry forward for me to carry for the next day for the Nifty option, it came down to 37,000 rupees. From 1,69,000 rupees, it came down to 37,000 rupees plus this 14,000 value of this my call option. That means almost 51,000. So with 51,000 rupees in my account, I can carry forward a short position in Nifty for the next day. and I traded 21 lots. So if I wanted to naked short, if I want to do it, I should have 1,69,000 into 21. But in this case, what I could do is that with 53,000 into 21, that is the that is almost 11 lakhs rupees. I could short 21 lots of this thing, and next day morning I see what when I hedge it, what I do is that next day morning, based on the market behavior, the pre-market behavior, or how it shows, I decide which one to close first. So if I think the market is going to go the opposite of what I am expecting, that market is going to go up, immediately I will do one thing. What I'll do is that immediately in the opening I will close my future short and keep my options with me, and so options will go up, so I'll be in advantage. My future will be where it is in the opening itself, and at a higher prices I'll try to short the future again. If it happens the opposite side, if the market is coming down, then I'll just immediately close that option and keep my short position in with me until the market ends that day evening at whatever the thing is that, and I'll keep a stop loss at what price I sold the option. And if that stop loss doesn't take out, then when before the market close, if I again carry forward for the next day also, then I'll buy the same option at the price available, which will be much lesser than what I sold it. So that advantage also I will get it. So that is how hedging is done, and I do the hedging based on that. That is basically for the margin requirement. And also you have to know exactly how to play with the hedging part. If you just keep both in hand, because if I am shorting now Nifty future and buying a 14,400 call option, the thing is that the Nifty, if Nifty falls by 1 point, my call option also will fall by 35, how much it is, 0.48. That, I mean, 50%, that also will fall. That like 48 paise it will fall if Nifty fall. But so what I am getting is only 52 paise. I will not get 1 rupee if Nifty fall 1 point also. So that is advantage, that there you have to know how to play around when the market opens the next day. Don't keep your hedge positions throughout the day. That do it only like if you're thinking the market is going to go up after 2 o'clock, just take your options, buy your options and keep it ready. And by the time market goes up and before closing, put your short, if you are planning for a short carry forward position. So basically that is the how it has to be done, and you have to know exactly it is that I can explain it to you if anybody is attending my webinar classes. Now the thing is that how to predict the price movement of a script based on open interest. That is basically not trading an option, that using an option chain to predict the price movement, where the prices will be for a particular script or an index. Basically, with a limited this thing, what I can explain is that on Thursday, that was a weekly expiry day. The price of the open interest of 14,700 put of 21 January expiry, that means Thursday expiry, was 70 lakhs at almost at 12:30. At 12:30, when I checked up, it was like, so at that time, some of the groups I already posted that, okay, it is difficult for that 14,700 to break, because it was having 70 lakh shares as a support over there. And the addition was like from the previous day, the increase in open interest was almost 1,000%. So that was a huge increase in put options. So that means breaking a 14,700 is a difficult task. So the put writers are basically, or the option writers are basically professionals. So they write it basically after studying completely on it. But what happened is that after 2 o'clock, I also had a clear cut this thing onto my mind that it has to fall. But that day I was already holding a position. I was having a February future at 14,783, but I didn't expect that fall to happen that day. I kept it for the next day only. I took the position for the next day only. But the least expectation was not there for me for a fall below 14,700, because I was expecting sure that the market will not go above 14,750. That will be the maximum it can happen. So, and that almost happened also. So what happened is that once this 14,700 was first broken almost after 2 o'clock, nothing changed in the open interest. It went. So it came up to 14,700, 690 something. Then when I saw that, okay, open interest is not changing, that means nothing is going to happen. Then market again went up. But for the next time, when it was coming towards 14,700 and it was dropping to below 14,700, this open interest of 14,700 put option dropped from 70 lakhs to 35 lakhs, always 50, 55, 30, 50% of this thing, call writers wiped off or squared off their positions. That means then it is sure the market is going to fall. So that is where the open interest, option chain open interest works out for you to predict the movement. So that, say, with one screen or one mobile phone, if you start doing all these things, you will not reach anywhere. That is possible only for professional, but only if you are planning to have a career into it. Participate in the web there. We'll explain in detail. You will understand basically, and you can work accordingly. Now, as of now, what open interest says, because that is because this being a monthly expiry, the range will be too much. What open interest says, the range for the next week is 14,000 to 15,000. That is not the actual one exactly. That you will come to know only by Tuesday exactly what it is going to be, because this the Nifty of expiry, this is a monthly expiry. Since weekly expiries is there, the monthly expiry will be I mean, the put an option, put and call writing will be too big. Like the difference between the put call ratio PCR will be too high. And in this case, 14,000 and 15,000 is the 14,000 is the support and 15,000 is the resist as per this option data. But this will change by Monday evening. We'll exactly come to know. Monday also I'll put in a video and I'll explain to you what is the changes. If you want, you can take the screenshot and keep it with you. And I'll keep it. This is on the Saturday morning. This is what the option chain says. I'll keep the screenshot and I'll show you what is the change that has happened by Monday evening. By Monday evening, you will come to know exactly where our, not exactly, approximate idea, what will be the range of Nifty for the next 1 week. So this is what this is a brief description of options. Now, in this weekend, just go through my video, just sit and understand from that. Don't venture into it if you don't know. And if you want to learn it, let me know. My number is there. Every Saturday I'm having a webinars, so you can join into that. But till then, goodbye.